Welcome to Total Convexity, our podcast series, and this is episode 18, which is being recorded on the 16th of May, 2025. I'm your host, Henrik Neuhaus, and joining me is my co-host, Jim Wang. Economic and business cycles are a foundational part of our investment philosophy. Jim, currently, you believe that we are at the confluence of multiple long-term transitions. For example, cyclically, we're at the end of a 3 to 8 year business and economic cycle. Secularly, we are transitioning from a 4-decade-long disinflationary regime into what probably will be a prolonged period of rising inflation. And thirdly, geopolitically, we're moving from a unipolar world dominated by the United States post-Cold War into a multipolar system where US dollar hegemony and military supremacy are being increasingly challenged. This shift will have profound implications on global economic cycles and underpins our long-term inflation thesis. In past installments of this podcast series, we have devoted quite a lot of time to discussing economic cycles and long-term secular inflation cycles. So perhaps today, Jim, we can talk about the geopolitical shift and the US dollar reserve currency status and how that is related to long-term investment decisions. Jim?
Right, Henrik. So in this podcast, I think our focus is investment and economics, right? But obviously, and that is closely related to geopolitics. And I would say that we are at a major transition time period from the post-Cold War time period of a unipolar world where US dominate the global order into a new polar world where the US hegemony and the dollar as a reserve currency status are increasingly getting challenged. I am not saying this is the end of US hegemony, nor I'm saying this is the end of US reserve currency. However, I do think that the US status are being eroded, and more importantly, from the economic perspective, I would dare to to hypothesize that we could potentially, at the transition period, from the US exceptionalism into another brave new world. So from economic perspective, I would say the post-World War economic order could be categorized as global vendor financing model. Here's an oversimplification. Basically, United States consumed and the rest of the world produced. As the result, the US run persistent trade deficit, while the countries such as emerging countries like China, Germany, and Japan amassed the surpluses. Now, these surpluses were then recycled into the US financial market, either through treasury securities and also US stocks, because the US dollar's role as the global reserve currency. Now, running persistent deficit is not a flaw, but rather a structural feature of being the issuers of the world reserve currency. In this framework, globalization, supply chain integration, and free trade underpin global economic growth, and they lift hundreds of millions of people out of poverty. Now, the biggest beneficiary of this globalization is the United States, because the consumers can enjoy cheaper goods and investors benefit from appreciating asset values. Now, let's just look at these numbers. The US population is 4% of the global population, but it represents 27% of the global consumption and the 30% of the global wealth, right? So here in the US, basically, you can enjoy the French wines, you can enjoy, cheap electronics from China, and all the good things, right? And this I think the French refer to this as exorbitant privilege of the US dollars. So I think the change of this is going to be very profound. And I think we can discuss why I think this is ending, and also give historical context. So just let me know where you want to start.
Right, Jim. Well, I guess for some, this is a shocking notion. Yes, let's get some historical context and how the central position of the US has been evolving and changing over the past few decades. Jim?
Right. So I think, I don't want to say globalization started after the fall of the Berlin Wall, right? But I think it certainly accelerated from there. Basically, the global emerging market force were integrated, started, being integrated into the global supply chain. Trade barriers are starting to be removed. There's a free flow of a trade, basically improving the efficiency of productions and the global supply chain, right? And I think one of the key moment is basically Asian financial crisis. So remember, during the Asian financial crisis, the root cause was basically a lot of Asian countries. They were borrowing U.S. dollars, and when the U.S. dollar appreciated in value after Greenspan had hiked the interest rate in 1994, right? And because of the rapid appreciation of the rising U.S. dollars, and also weakness of their domestic economy, and that create tremendous strain on their domestic, the market. I think at the conclusion of this Asian financial crisis, at the end of the Asian financial crisis, I think the conclusion is that they need to accumulate a lot of FX reserve, and particularly use U.S. dollars, right? So basically that's the time, the emerging market countries, once they got a surplus from the US, by exporting to the US, and they started to reinvesting into the US financial market by buying the US Treasury. And as you may well know, that's the time, Greenspan was talking about the conundrum and global savings glut, right? It all started from there. And obviously, this is all accelerated after China joined WTO. I think it was December 2001, and that's more than 2 decades ago, 24 years ago. And you have even a bigger pool of labor, a labor market integrated into the global labor market. And as China export more into the rest of the world and into the US, they accumulate massive FX reserve, and that was also recycled into the U.S. Treasury. Obviously, I think it has been longstanding that the oil exporters like Saudis and etc., and we call them petrodollars, they sell the oils and denominated in U.S. dollars, and once they get the dollars, and they also reinvest into the U.S. Treasury, right? So this is all good and so I think it's into the regarding the financial market. I would say this is also really turbocharged after great financial crisis. And if you recall, we have Abenomics in 2002 to 2014, where basically Japan cut the interest rate to zero and start massive, QE program. And the net QE program, the result is basically you have a zero interest rate, and at the same time your currency is going to depreciate. I mean, the best thing to take advantage of this is you borrow Japanese yen, where the interest rate is zero, and you invest in the rest of the world, and you return the currency, which is going to be depreciating over time. So it's extremely profitable and logical and trade. And a lot, vast majority of the money also flew into the United States. Now, once, and then I think ECB basically took over the baton in 2014. So after, we all know there is a European, debt crisis, right? And what come after the debt crisis is that ECB was forced to start QE and monetize their debt. Now, similar thing happened. Interest rate went down to zero, and so massive of capital when leaving Europe and went to the United States. And this also, had great stories, at the same time, because U.S. technology, large tech, companies was dominating the world, that create stories not only from the capital flow perspective, but also from storytelling perspective, that the U.S. is growth engine and is the innovation leaders, and all that is true. And I think the peak really came after, post-COVID fiscal stimulus, right? And the U.S. fiscal stimulus is basically the largest in the U.S. entire history, and is the largest versus the rest of the world. And like I said, fiscal spending, government fiscal spending is basically private sector's revenue, right? So that fuel the economic growth and fuel the asset bubbles, and that also reinforce the story where the U.S. grows, the story of U.S. exceptionalism, and that result even bigger foreign capital flows into the U.S. equities, right? U.S. financial asset. So I think the result is, we can all see this, that, I mean, anecdotally, I mean, we know that, Europeans and Chinese and Asians and Japanese and Korean, I mean, they all invest in the U.S. market, and they were trading the tech, stocks. Now, if I look at this, right, the U.S. stock market have long gone, have basically making new all-time high to new all-time highs. But I'm showing this chart of the European stock market, right? And this is in the local currency, okay? I use SX5E index, Euro stocks. It peaked in tech bubble, and we basically just break out, matching the same levels, right? And if you look at European banks, I mean, they are still at 2009's level, right? Now, if you look at emerging market right now, and we still haven't made all-time high yet, right? And if you look at Brazil, I mean, we are still at a similar level, like after after the burst of the tech bubble. After the burst of the subprime bubble, and a similar level, after COVID, right? So really at the bottom. So I think the discrepancy between the U.S. asset valuation versus the rest of the world is the highest. We've never seen this before. And obviously, the valuation of the U.S. stocks versus its own valuation is the highest as well, among the highest, right? Borrowing from two time period. One is before 1929, the other one is 2000. And versus the bond, right, which is we call it risk-free rate, is among one of the highest as well. So why is that the case? Like I said, one is because the globalization help U.S. corporations margin. Their margin, their cost base, a lot is in China and the rest of the world. So their cost base is low, and the revenue is here in the U.S. So that helped them increasing margins, right? So the U.S. corporations is most, this is the most profitable time period for them. At the same time, the market assigned very high valuation to this margin, and the very high valuation is the result of this, the result of the capital flow, right? When the capital outflow here, it push up the asset price and the valuation reach, the extreme, levels. And obviously, from our perspective, I would say here, I mean, this is a very long-term secular trend, and it may last for quite some time, and the timing is always very tricky. And I think we basically, put our neck out saying that this is probably the reversal time right now. And I would say once this trend reverse, there will be the huge implications. So happy to discuss more details into that.
Yeah, absolutely. So, what are other factors contributing to this, let's say, the reversal of this mega trend, Jim?
Right. So we are basically talking about the reversal of this big trend, right? And obviously, any reversal of a trend like this is going to take some time. There have been signs, um, and it's never a event, but rather a process. And I would like to go back all the way to 2008 and 2009 financial crisis. I would say the US dollar is considered as a reserve currency, right? So it's almost as good as gold, although it was depacked from gold after Nixon shock. But sometimes even better than gold because it also carry the interest, right? And you have also credible central bank and basically to deal with the inflation. And I would say U.S. fiscal situation in the past, generally speaking, still responsible fiscal policy. And I think after the subprime crisis, I think the Chinese basically found out that hey, it's not just the emerging countries, but essentially U.S. can just print trillions of dollars to just monetize their debt. And just remember when Chinese export all the goods and through hard labors and workings, factories and all this, right? In exchange for trillions of FX reserve, and the U.S. just can print over a few quarters, right? So I think that's kind of a wake-up call. In a sense, they say, okay, what are we going to do with this FX reserve? Where I think the initiative of One Belt, One Road, it started thinking from there. Is like, let's spend this building real things, and not just hold these papers. And I think another thing after the global financial crisis is the rising of the shale oil and the shale gas. And not only U.S. has become energy independent and also become energy exporters, right? So remember, petrodollars is those FX, those FX, accumulation of these oil exporters, right? They were recycled into the U.S. Now, once the U.S. become, export, energy independent, actually U.S. is, exporters of energy, right? Those surplus have diminished, right, between the U.S. and the Saudis, right? And instead, Saudis will export into the China, and then naturally, I mean, Chinese will basically say that why don't we just try to settle this trade using our currency by ourselves, right? So I think these things happen one thing after another, right? And then I think the most recent one is more kind of a Russian war. The war, the war in Russia, between Russia and Ukraine, and people, realize that whatever you hold is actually does not belong to you, and it can be frozen. And anyone who have FX reserve in the U.S. dollars need to think about that. Potentially one day, if you do not do what U.S. government asks you to do, and you may lose all your FX reserve. And I think since of that, I mean, a lot of countries realize that they have to move away from the U.S. dollars. Obviously, there's no replacement for that, right? So I think the first step is they start to to settle the trade using their own currencies and etc. Now I'm sympathetic to the idea that increase using the the Chinese yuan and or the local currency like Brazilian real and the Russian ruble, they do not replace U.S. dollar as a currency reserve, right? Because this is just trading currency. I mean, what do they do once they get that currency? I mean, if they need to reinvest, they probably still reinvest into the U.S. Treasury, because there is no other, global, capital market from the other countries is able to absorb that. I am sympathetic to the idea and I agree with that idea. However, I think this is just a starting point of a long process, right? Because a lot of people, the purpose of holding US dollars is because it's for trading purpose, for global trade purpose. Like you need US dollars to settle the global trade. Now, if you do not need the US dollars to settle global trade and the need to hold the US dollars as a reserve will diminish, right? That's the first thing. Second thing here is, I think through this, and we can talk about this, the U.S., policy. In the end, I think it will result the lower, deficit in the U.S., and that means less surplus from the other countries. And if the less surplus means less need to reinvest into the U.S. Into the U.S. Treasury market. And this is coming at a time where we have a record deficit, record of issuance of treasury need to be absorbed, right? So, and I would say the most recent another kind of a consequence of this of the Russian and the Ukraine conflict is that suddenly I think Europeans realize that they really need to spend capitals and in infrastructure spending. And I would also say recently, the Trump administration also disrupt the NATO alliances and things like that with Europe. And they also realize not only they need to spend on the infrastructure, and they cannot reliably rely on the U.S. defense. As a result, they need to build up their defense industry as well, and they're going to spend the money. Guess where the money is? The money here is in U.S., right? So I think from both private and the public sector perspective, a lot of money was going to be leaving the U.S. and then go back to the Europe, and because of this fiscal spending in Europe, and we also highlighted in the past that there is also monetary divergence between the Japan and the Europe, Japan and the U.S. And we talk about this carry trade, right? The Japan, since the BOJ, since the Abenomics, right? Japan basically have the de facto carry currency of the world, and buying all the U.S. asset and all over the world. Now, Japan's inflation is high, and they want to hike, right? And U.S., I think the Fed bias is they want to cut, right? Now, if the economy is doing very well, like there's no global recession and everything is rosy, and I would say inflation in Japan will become a problem, and that will force them to hike. Now, if the global growth slow down and then there is a recession, and Fed will cut interest rate, and Japan, because they have a zero bound, it's difficult for them to cut interest rate. I think the message here is that the interest rate, the record interest rate spread between the U.S. and Japan is likely going to narrow, and that will probably result in the higher Japanese yen, and where will result in a lot of unwind of the carry trade. And I think finally, if there's not enough, right? All this is the trend is basically set in motion, right? And I think what sealed the deal is basically the Trump, the goal to basically to reduce deficit, right? And the Trump, I think the strategy associated with this is tariff, right? And the underlying message is basically the strategic goal is to bring the manufacturing jobs back into the United States, and build more things here in the U.S. And the whole thing here, the whole idea is to reduce the deficit, reduce the the trade deficit. And like I said, right, the trade deficit is basically a feature of being the reserve currency, and that's why you can print the money and without much consequence. And so I think that's basically, I think this is a big deal. Not only the rest of the world is starting doing this, now the U.S., itself also, are basically in line with this mega trend. They are not fighting this trend, and basically they are joining and accelerating this trend. That's why I think this is happening at a faster speed.
Right. But we have established, and there's no doubt about this, I mean, it's generally agreed to that the US, both as an economy and a country in the aggregate, has been well served by globalization and by the dollar being the premier reserve currency and, treasuries being the safe place to invest. So why on earth would any US administration want to jeopardize this apex position? I'm wondering, Jim.
Right. I don't think they want to jeopardize in this position per se, because if you can enjoy the cheap goods all over the world, at the same time you can have your financial asset appreciate, and you can have a 4% of a population but consume 27% of the world product, and have a 30% of the world wealth. Why you want to change it, right? I think the problem here is that these benefits are not evenly distributed, right? And most of this go to the US corporations, like I said, because they enjoy the record profit and they are the biggest winners. So not only they enjoy the record profit, they are also enjoying the record valuation because of the capital inflow. So basically, all of people all over the world are buying, their stocks and the financial asset, right? But they are losers, right? These are basically the blue collar workers, right? You are talking about, a lot of things we're talking about during the Trump campaign is how Detroit and the Rusty Belt is towns and the counties and etc. Just became deserted, and the ghost towns, and then all the problem and the drug and all this associated with that, right? And a lot of them are Trump supporters, right? So I think in order to help this this voting his constituents, and I think Trump is carrying out his word to bring back these manufacturing jobs. So I think that's one that's one of the key consideration, right? I think the other second key consideration is also the consequence of a multipolar world, where the U.S. suddenly realized that their military supremacy cannot be taken for granted. And a lot of things, for strategic reasons, a lot of things like defense and the medications and all this, and you probably want to produce domestically, right? So that's another reason to bring the manufacturing back into the U.S. Now, note that this world is different, right? Is very different than the past, where that if you think about whatever industry, defense industry, or building whatever high tech, right? You basically have the components. It's a global supply chain. You still have a lot of components, manufactured in China, and you still need to rely on them. And I would say this is extremely complicated and difficult to rebuild. But nonetheless, that's the government kind of their objective. I would say you would also may want to say here is that, well, maybe this is just Trump administration one time, and after Trump is gone, maybe we'll go back to the same old world. Maybe that's the case, but I think during this process, I think it's coming to the consensus in the Democrats agree that probably the reason why Trump win this is because of this manufacturing job, and I think it's also the bipartisan consensus. Basically, bring my job back job to bring the jobs back to the U.S. and strategic decoupling, I think that's the word of Scott said, does have a bipartisan support. And I think that trend is probably going to continue. And like I said, if you try to reduce the trade deficit, you will reduce the capital surplus. So I think the net result is going to be really, really big. So, I mean, if I think, we can talk about what's the consequence and what's the implications.
Right. Well, this is a sobering outlook. So, okay. So, what are the medium and longer term investment implications for this reversing secular trend, Jim?
Right. So, so I think this trend is basic. I think the reverse of this trend is basically the reverse of the benefits that we have enjoyed. What are the benefits? It's basically the cheap product and goods and the US consumers can enjoy, and the very high financial, basically the financial value, financial asset appreciation enjoyed by the investors. And both of them will reverse, meaning, the consumer price, the inflation will go higher, and either you import this inflation, right? And Or if you produce here in the US, you will just hire domestic production cost. And because another one, I mean, in the end, you will have a higher inflation, but then lower corporate profit margin because the corporation, their cost base is going to be here. I mean, just think about this. Trump just recently tweeted, said, Apple, you cannot build in China. By the way, you cannot build in the manufacturing, factories in India either. I mean, you have to build here. So when you build here, two things can happen. One is, it will be more expensive, so you pass over to the consumers. Now, if you cannot pass over to consumers, and you have to eat it yourself, and that will result in the lower profit margin, right? So it will be higher inflation and lower profit for the corporations. And at the same time, because the world no longer have a surplus capital from the US, because US no longer run as large deficit as before, there will be less reinvestment of the capital back into the US, and then that will result the lower valuation of the financial the asset. So net result is falling. I would say the real return of the asset prices will go down. Inflation will go higher. Corporate profit will drop. Profit valuation will go lower. And I think that's the net effect. Now, I would say because of US dollar reserve currency status, right, the rest of the world have always been willing to fund the US spending. And obviously, things have changed after the subprime crisis. And when that is not enough, the US dollar will just turn on, the US government will just turn on the printing press, just to monetize it. And this accelerate after the COVID, like I said, after the COVID, post the COVID world. And in the sense, I think, if the US remains, I just put this way. I mean, I think there's only two countries who can print money without consequence, right? Without inflation consequence. One is the United States, and the reason is because you print money, and that because US dollar is the reserve currency, and everyone want to hold it. So it still has a value, right? Otherwise, you will be just the same as Argentina and the other countries, right? And we talk about this in the recent episode. I think although it happened for a short period of time, and I suspect it will come back again, is that during the deep sell-off of post-liberation days, and you have a stocks plunged, and you actually have the U.S. Treasury yield go higher, went higher, and U.S. dollars and depreciate at the same time, and that's not characteristic of the reserve currency, right? That's a characteristic of emerging, countries. And I'm not saying that that will be the market reaction all the time, but I would say this will come back, and we will see that more often than any time in the history. Another country I think they can print money without consequence is China, and unfortunately they are not printing money. And I would say they should have no problem to print money, because the constraint to print money, right, is one is I think like in the U.S. is because there's no constraint because you're reserve currency. I mean, the reason why Argentina and the other country, when they print money to fund their spending, is because they need to import the goods. They do not have the domestic production capacity. And the only thing they have is maybe some commodities, and they can sell their commodities and in exchange for the other product and the services. But because you print so much money, and the paper demand for the whatever goods may not satisfy the paper demand, and then the paper have to devalue. Now, because China have a large production capacity, and we call them a surplus, right? Kind of excess capacity, because it cannot be absorbed domestically, so it went all over the world. And if they print money, and the domestic people have the consumption demand, and that demand can be easily satisfied by the domestic production, and as a result, the currency will not depreciate, and the economy will grow. And obviously they are not doing that. But coming back to the consequence, right? And in the U.S., I would say I want to come back to this notion, come back to the statistics I gave to you. And 4% of population, 27% of consumption, of global consumption, and 30% of the wealth. And if this trend reverse, right? I mean, the US can still have a 5% of the world population, maybe not consume 27%, maybe consume 15% of the world consumption, maybe not a 30% of the global wealth, maybe by the end of the next 1 decade and 2 decades, and it will be 15% of the global wealth. Now, I think that statistic, if you look back, and that could well be the case. And if you look back, and I would say tremendous changes will happen in the next 1 to 2 decades, where the financial asset outperformance may well happen in the rest of the outside of the U.S. And I think this implication is big. By the way, this is I'm not saying that we need to end the US dollar reserve currency. We just need to have the same kind of a dollar depreciation cycle that we have had before, post burst of a tech bubble, and post the Plaza Accord, and post Nixon shock, right? Each of this time period, Nixon shock and Plaza Accord and peak of tech bubble, all those basically mark the peak of the US dollar. Although US dollar continue to be reserve currency, and that does not prevent the US asset underperformance in the decade to come. And I think we could be at the verge of that moment.
Okay. So what should an investor do, or what could an investor do to protect themselves, or possibly even thrive in this changing environment? What are the opportunities?
Right. So I think most investors always look things in the mirror image, right, and extrapolate what's gonna happen in the future, and that's the very definition of a trend following. But I think at some circular turning point, and one have to be pay close attentions to this, and obviously time horizon matters, right? So we are talking about long period of time. So I think we are entering a world categorized by very high volatility and elevated geopolitical risk, and this is a structure shift of the capital flow that I'm talking about. So it will be a lot of uncertainty, but I also think that will represent a lot of opportunities. And if I'm looking at this, I would say strategically for the long-term investors, and I think you should basically sell the strengths, right? Because this is a long time this is a long-term process, so you don't need to go out the window and just stop everything, right? But I think gradually you should sell the strengths of the U.S. financial asset, and then I think you should buy the weakness into the non-US, non-US financial asset, and also the real asset, being gold and we have a views that the commodities may have a weakness in the next few quarters, and because of potentially the economic slowdown and slowdown and the potential recession. But that, for the long-term investors, that could be a buying opportunities. And I think we want to come back to the U.S. fiscal situation, right here. Is like we have talking about that that typically the U.S. debt will be funded by overseas so-called savings glut, and I would say this savings glut are being tremendously diminished because their surplus are diminished, and because of the things that we have been talking about, is there will be less capital recycled back to invest in the U.S., and that has to be absorbed by the domestic, the U.S. itself. There's two ways to fund it. One is you have to liquidate the other financial asset to fund it, meaning the stock price goes down and you fund the U.S. Treasury, and that is a painful thing to do. And naturally, it will all ended up with the U.S. Federal Reserve, printing money, and by the U.S. Treasury. I think that's the destiny, but I think the path towards that is important, where typically there will be a pain, right? And to force the Fed to come here and monetize the debt. Obviously, I have to admit the pain threshold is getting less and less. In the past, you require recession, you require this significant collapse of asset prices for the Fed to start QE. Now the hurdle rate is getting less and less. I think it's it's important to navigate this in terms of sequence. What's probably is going to happen, and what's the reaction function of the federal government. From that notion, I think in the short term, in the near term, I think the short dated Treasury rates probably stay low and can come lower if our scenario of the recession and the growth slowdown materialize. And if that's the case, the long dated rates may come down as well, but less. In other words, curve will steepen. And I think once the government starts stimulating, and then I think we'll have a next leg of sell-off of the treasury, of the treasury securities, and that may happen at the same time when the U.S. Dollar could fall at the same time. So that's kind of our, what I think about the investment implications. And I just remember this is a very long term and a secular thesis, and is not something that is not going to unwind overnight. So I think this is just something bear in mind as a macro backdrop when you make investment decisions, particularly if this is a long-term investment decisions.
Right. Or yes, or basically then in the longer term, there would be a diminishing home country bias for long-term investors and more of a move towards perhaps a global market portfolio or something like that, right?
That's right.
Right. Okay. Well, we have now come to the end of episode 18 of Total Convexity, but I would just like to add an observation of my own. In this podcast series, we focus on economic and financial realities and mechanisms, and what the consequences of economic and financial changes imply for the markets in the US and globally. At the same time, it really is not possible to avoid mentioning the big white elephant in the room, which is that the US no longer has the desire to be a shining city on a hill. A notion that has been driving US policymaking for the past 4, 5, 6 decades. Abandoning this notion will, I believe, accelerate the secular trend reversal that Jim has outlined. Down the road, history will tell how fast change will have come upon us. So I think that it is very important to bear in mind that things could change much faster than any well-reasoned economic theory would imply. It's a big change, and we don't really know how it's going to play out. Listeners can follow us by searching for Total Convexity in their favorite podcast apps or on YouTube. Please don't forget to click on the subscription button so that you will be automatically notified when a new episode becomes available. You can also follow us on X, where we have the handle @TotalConvexity. And you can also email us at totalconvexity@gmail.com. Finally, you can follow our insights on Substack at totalconvexity.substack.com. Thank you. Jim?
Yeah, thank you, everyone. And if you like this podcast, we would appreciate if you can pass along to anyone who may be interested. And this concludes episode 18 of our podcast, Total Convexity. See you next time.
Disclaimer. The information provided in this podcast is for general informational purposes only and should not be considered as financial advice. Consult with a qualified financial professional before making any financial decisions. All investments involve risks. There are no guarantees of profits, and investments may incur losses. The contents discussed in this podcast is not a recommendation for any specific investment. Past performance does not predict future results. The opinions expressed by guests on this podcast are their own and may not necessarily reflect the views of the hosts or affiliated parties. The podcast host and guests may have financial interests in companies or products discussed, and listeners should be aware that the opinions expressed by guests and their hosts may reflect biases. We strive for accuracy, but financial information can change rapidly. The content may not always be up to date or complete, so verify information independently. This podcast does not offer legal or regulatory advice, and listeners are responsible for ensuring that their financial decisions comply with applicable laws and regulations. Mentions of specific financial products or services do not constitute endorsements. Perform your due diligence before engaging with any financial offering. Listeners are fully responsible for their financial decisions, and the podcast's guests, hosts, and affiliated entities are not liable for any financial losses resulting from actions taken based on the provided contents.